You've heard it 1,000 times. Just be patient and let compounding do the work. But what if I told you that's not how the wealthy actually play the game? In fact, most of what you've been taught about compounding is incomplete. And if you don't understand what's missing, you might be compounding your way straight into mediocrity. Years ago, a man named Carlos followed the classic compounding advice to the letter. Every paycheck, he diligently invested a fixed amount. He watched the charts. He celebrated his steady returns. And after 20 years, he looked at his net worth and realized something gut-wrenching. While he was waiting, his wealthy peers had multiplied their wealth, not by just sitting back, but by stacking income, leveraging debt, and shifting strategies when the tide changed. Carlos wasn't lazy. He was loyal to a system designed for safety, not speed. That's when he realized compounding alone isn't the engine, it's the fuel. And the vehicle? That's what we're talking about today. Before we dive deep, just a quick heads up. This is part 3 of our 5-part compounding comeback series. If you haven't watched part 1 and part 2, I highly recommend checking them out after this video finishes. They set the foundation for what you're about to learn. I've added the link for you right below this video. And if you're enjoying this series so far, go ahead and subscribe to Trip to Wealth right now, so you don't miss the rest of this game-changing journey. Let's kick things off with the first truth the wealthy understand about compounding. They don't wait for it. They work with it. See, for most people, compounding is sold as this magical formula. Just invest early, stay consistent, and give it time. But what you're rarely told is that time by itself doesn't create wealth. It only amplifies the inputs you feed it. If the input is weak, the output will be too. And that's exactly where most people get stuck. They think that by playing it safe and reinvesting slowly, they'll somehow catch up. But that's a myth. The wealthy know something different. Passive compounding is a nice baseline, not a strategy. Let's break that down. Imagine 2 investors. One parks $10,000 and reinvests passively, earning 7% a year. The other starts with $10,000 too, but they stack new income streams on top, inject more capital as their career grows, and time their risks during moments of high upside. 10 years later, these 2 people don't just have different returns, they're living in different financial realities. One has a modest portfolio and peace of mind. The other has financial freedom, flexibility, and leverage, not because of patience, but because of movement. That's the biggest misunderstanding we need to correct right now. Compounding isn't passive, it's participatory. And the sooner you stop treating it like an automatic savings plan and start treating it like a dynamic wealth engine, the sooner things will shift. Because here's what the wealthy really do. They use compounding to amplify momentum, not to wait in line for results. Moving forward, let's talk about the strategy that quietly separates the wealthy from everyone else when it comes to compounding: the stacking effect. Most people think the game is about waiting. They think if they just stay consistent and don't touch their money, it'll grow into something magical. But here's the truth. Waiting without adding is stagnation. What the wealthy do differently is they stack constantly. They stack income, stack assets, stack returns, and most importantly, they stack opportunities. Let's get specific. While the average investor might contribute $500 a month and feel proud of their discipline, the wealthy treat every new income stream, side hustle, windfall, business, dividend, rental, as something that needs to be reinvested aggressively, not recklessly, strategically. Why? Because they understand that compounding isn't just a time function, it's a velocity game. The more they feed it, the faster the engine turns. The more cylinders they add, the more torque they generate. Here's the mindset shift. Regular people contribute from what's left over. The wealthy design their lives to create excess, then fuel the machine with it. They don't think in terms of expenses. They think in terms of capacity. Can I stack more this quarter? Can I move profits into higher-yielding vehicles? Can I time a dip and double down? This is where the narrative flips. If you're only relying on time, you'll eventually grow, slowly. But if you're constantly stacking, you're not just growing, you're accelerating. And acceleration is how compounding transforms from a slow burn into a wealth explosion. Coming up next, we'll expose a silent enemy of that acceleration, the thing that quietly erodes compounding when you're not looking: lifestyle creep. All right, the next truth stings a little, but it's absolutely critical. Let's talk about lifestyle creep, the sneaky force that silently kills compounding momentum. Most people don't even realize it's happening until years have passed and they look back, wondering why their financial growth stalled despite doing everything right. Here's how it works. You get a raise. You start earning a little more. Instead of redirecting that surplus into your compounding engine, you spend it. Not recklessly, but subtly. A nicer car, a slightly bigger apartment, upgraded phone, dining out a bit more, one step at a time. Nothing outrageous. But here's the trap. The money that was supposed to feed your financial engine now feeds your ego. Wealthy people know this. That's why many of them live below their means, not because they're frugal, but because they're strategic. They understand that every dollar that doesn't go into compounding is a future opportunity lost. And worse, when lifestyle creep locks you into higher expenses, it reduces your flexibility, the one thing you must have to build wealth. Think of it this way. Compound interest is like a snowball rolling downhill. Lifestyle creep is like dragging that snowball through wet cement. It slows it down, sticks to it, weighs it down. Eventually, it's not even moving anymore, just sitting there, looking impressive but going nowhere. Want to know why so many high-income earners still feel broke? It's not the math. It's the creep. It's the slow, invisible shift from investing to indulging, from building to maintaining appearances, from momentum to maintenance. And that's why in the next topic, we're going to dig into the strategy that flips the script completely: asset multiplication, and how the wealthy use it to outpace everyone else without increasing their risk. By the way, if you're enjoying part 3 of our Compounding Comeback series and want part 4 sooner, drop the word comeback in the comments, so I know you're with me. Now let's talk about what actually accelerates wealth beyond basic compounding, and why most people never even hear about it. It's called asset multiplication. This isn't just reinvesting in the same thing over and over. It's about turning one source of wealth into multiple, strategically layered assets that each compound in parallel, not in isolation. Here's how the wealthy play this game. They don't just buy stocks and wait. They use the growth from one asset to acquire another. Profits from a business? Used to buy real estate. Gains from real estate? Rolled into dividend-producing equities? Income from those equities? Partially reinvested and partially used to build private investments or funds. This isn't passive income, it's strategic duplication, building systems where each layer reinforces the others. Now let's compare that to what most people do. They max out a 401k, set it to autopilot, and hope that over 30 years it'll be enough. But that strategy relies entirely on one stream, with zero flexibility, no parallel growth, and limited adaptability if markets shift or life throws a curveball. And here's the twist. This isn't about how much you start with. It's about how you use the gains. The wealthy treat compounding as a ladder, not a parking lot. Each level of return is a stepping stone to a broader portfolio, not a waiting room for retirement. The takeaway? If you want to mimic the wealthy, stop thinking in terms of a single compounding engine. Start thinking in multiples. Your money should be working in layers, not in silos. Now that you see how this framework works, let's move into something most people never connect with compounding. Yet it might be the reason their whole strategy eventually stalls: the role of timing. Let's now uncover a truth almost no one talks about when it comes to compounding. Timing isn't just about when you start. It's about how you move. Most people think the earlier you start, the better. And yes, that's true, to a point. But what the wealthy understand is that timing is also about leverage, positioning, and momentum. It's not just time in the market, it's what you do while you're in it. Here's the difference. A regular investor starts early, contributes consistently, and waits. A wealthy investor? They start early too, but they know when to shift, when to double down, when to pause reinvestment and redirect into a high-growth asset. They move capital intentionally, not emotionally. It's chess, not checkers. Let's go deeper. If you're locked into a compounding strategy that doesn't allow for reallocation, that ignores economic shifts, market cycles, or business timing, then you're not compounding smartly. You're compounding blindly, and that's where opportunity dies. You can't afford to treat time like an automatic win. You have to treat it like a window, one that opens and closes depending on your ability to act. Think about this. If compounding were purely about time, then everyone who started saving at 25 would be rich by 55. But we know that's not reality, because wealth isn't just a function of time, it's a function of timed decisions. The wealthy don't just wait, they strike. And they strike when conditions are right. So if you've ever wondered why your compounding strategy feels like it's stalling despite doing everything right, this might be the reason. You're missing timing as a lever. Now let's move on and reveal how the wealthy actually reinvest, and why most people never replicate it. Let's now break down what this really looks like in practice. Because while most people think just reinvest everything is the smart move, the wealthy approach this with a formula, not a feeling. They don't blindly reinvest out of habit. They reinvest strategically based on three things: capacity, context, and calculated timing. First, capacity. The wealthy don't reinvest money they can't afford to lose access to. They separate lifestyle liquidity from growth capital. That means part of their income or returns is deliberately kept liquid, not for emergencies, but for opportunity flow. They want to be able to jump on undervalued assets, private deals, or early-stage entries without liquidating long-term positions at the wrong time. Second, context. They don't apply the same reinvestment rule across all assets. For example, compounding inside an index fund might make sense during a bull market, but in real estate or business, sometimes it's smarter to pull profits and deploy elsewhere. They look at economic signals, personal cash flow needs, and macro conditions before deciding if reinvestment is optimal or if a redirection makes more sense. Third, timing. The wealthy know that reinvesting isn't always wise at every point in the cycle. When valuations are stretched, they may pause reinvestment and stockpile capital. When the market corrects, they strike hard. Their formula includes timing reinvestments when the upside is asymmetric. That's the compounding edge most people never access. So no, the wealthy aren't anti-compounding. They just don't treat it like a religion. They use compounding when it serves them, and they pause when it doesn't. That flexibility is power. Remember, this isn't about timing the market. It's about understanding when your reinvestment truly pays off. And if you're wondering where to start building that kind of portfolio, here's where I'd start. Public.com gives you access to fractional investing, expert insights, and a structure built for long-term wealth. I've dropped the link below. You can open your account today and start practicing this strategy with real flexibility. And that brings us to the next key, the ultimate filter the wealthy use before every compounding decision: opportunity cost. Let's now talk about something that almost never gets discussed in traditional investing advice. And yet, it's what the wealthy obsess over: opportunity cost. Because here's the thing. When you choose to reinvest, you're not just choosing to grow your capital. You're also choosing to lock it up. And every time you lock it up, you're silently saying no to all the other things that capital could have done. Most people see reinvestment as a neutral or positive default. But the wealthy, they ask, is this the highest and best use of this money right now? That's a totally different question. They weigh reinvestment not just by return percentages, but by strategic potential, Maybe that 8% reinvested dividend sounds fine, until you realize it could have been used to enter a business partnership, buy discounted real estate, or seed a new cash-flowing asset. Suddenly, that same 8% return becomes a bottleneck. This is where the game changes, and where average investors fall behind, because they're taught to maximize returns within an asset. The wealthy focus on maximizing momentum between assets. It's not about squeezing every last drop from a fund. It's about constantly reallocating toward leverage, growth, and timing. And here's the irony. Sometimes the most powerful compounding move is to stop compounding, to pause, reallocate, and pursue asymmetric upside elsewhere. The person reinvesting into a bloated market gets slower, while the person pivoting into underpriced value gets ahead. So next time you hear, "just keep reinvesting," pause. Ask what you're actually giving up. That's the opportunity cost, and it might just be the difference between slow growth and real wealth. Now let's move into the final insight: how the wealthy build compounding momentum across their portfolio, not just inside one asset. All right, let's wrap this up with the most overlooked compounding lesson of all. Compounding doesn't just happen inside investments. It happens across your entire financial life when the pieces align. What the wealthy understand, and almost no one teaches, is that wealth isn't built by waiting 40 years for a stock portfolio to grow. It's built by stacking assets, opportunities, and timing in a way that generates momentum. Let me explain. When you invest $10,000 and reinvest for a 10% return, you get linear compounding, slow, predictable. But when you take those gains and use them to build something new, a business, a property, a high-leverage asset, you create layered returns. One move accelerates the next. That's momentum. That's what the wealthy are chasing. They're not thinking, "how do I grow this one fund forever?" They're thinking, "what sequence of moves multiplies my options, my income, my control?" That's why they don't blindly reinvest. They use every dollar like a chess piece, building toward bigger plays. And the truth is, this kind of momentum isn't reserved for billionaires. Anyone can begin. But it takes stepping back and seeing the full board. You're not just managing returns. You're managing movement, speed, direction, exit points, entry points. That's how wealth actually compounds, through intelligent shifts, not just passive holding. So, if compounding has felt slow or disappointing to you, it might not be because you're doing it wrong. It might be because you're doing only half of it. True compounding begins when you add intention to motion. Before we close, a quick reminder. This is part 3 of our 5-part compounding comeback series. After this, go back and watch part 1 and part 2 if you haven't yet. Both are linked below. Now, let's close it out. Let's pause here for a moment, not to stop the momentum, but to let it settle in. If you've been compounding with patience but without strategy, this might be the wake-up call you didn't know you needed. Because what we just explored isn't theory. It's what separates those who quietly build freedom from those who wait decades and still feel stuck. See, when most people hear compound interest, they think of one thing: a savings account or a mutual fund quietly growing over time. But the wealthy? They see compounding as a force, something that accelerates when leveraged across time, assets, cash flow, and timing. It's not just about staying in the game. It's about stacking the board in your favor. If this resonated with you, if a part of you knows you've been playing too small or too passive, then now is the moment to take back control. Not with reckless speed, but with focused momentum. That's what this series is here to offer, a full reset on what compounding really means and how to finally use it on your terms. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.